Most people think financial automation means setting up a direct deposit and calling it done. That's not automation. That's just not doing anything. Real financial automation is a system that moves your money to the right places at the right times without you making a single decision. When it's built correctly, you can go weeks or even months without actively thinking about your finances and still be making consistent progress toward every major goal you have. Today, I'm going to walk you through exactly how to build that system in 2026. Let's start with the architecture. The fundamental principle of a great automated money system is zero-decision money movement. Every dollar that comes in should have a predetermined destination. You should not be manually transferring money, manually paying bills, or manually deciding how much to invest each month. The system decides. You just check in occasionally to make sure it's still running correctly. The foundation is your checking account, but not a single checking account. The most effective automation systems use what I call a hub and spoke model. Your paycheck goes into one central hub account. From that hub, everything flows out automatically to spoke accounts with specific purposes. You have a bills account that receives an automatic transfer covering your fixed monthly obligations, rent or mortgage, utilities, subscriptions, insurance. You have a spending account that receives a fixed weekly or bi-weekly transfer for variable discretionary spending. You have a short-term savings account for your emergency fund top-ups and near-term goals. And your investment accounts sit at the end of the chain, receiving whatever remains after everything else is funded. The power of this structure is psychological as much as mechanical. When your spending account runs low, you know you've hit your spending limit for the period, without spreadsheets, without budget apps, without guilt. The constraint is built into the architecture. Now let's talk about the sequencing of transfers. The single most important rule in automation is invest before you spend. Your investment contributions should leave your account the same day your paycheck arrives, or the next business day at the latest. This is not just about discipline, it's about removing the decision entirely. When you automate investments to pull on payday, there is no money sitting in your checking account tempting you to spend it. It's gone to work before you even see it. For retirement accounts, if your employer offers a 401k or similar plan, contribution automation is already built in through payroll deduction. Take full advantage of it. If you have an IRA, set up automatic monthly contributions. For taxable brokerage accounts, set up recurring purchases of your target ETFs on a fixed schedule, monthly or bi-weekly. Most major brokers support automatic investment in fractional shares now, so minimum investment amounts are not a barrier. The debt payoff layer is where many people under-automate. If you have a mortgage, set up bi-weekly payments instead of monthly. This creates one extra full payment per year and can shave years off your loan without you feeling it. If you have student loans or a car loan, automate extra principal payments every month. Even an extra $50 a month on an auto loan shortens the payoff timeline meaningfully. And if you have any variable rate debt like credit cards or a HELOC, automate a monthly sweep of any checking surplus above your target buffer into those balances. Let's talk about optimization loops, the second-order automation that most people never implement. A basic optimization loop works like this. Once a year, or whenever your income increases, you run a review of your system and update the transfer amounts. Your lifestyle should not automatically expand to fill every raise. Instead, have a rule. For example, 50% of every net income increase goes to savings or investment increases, and 50% goes to lifestyle. Automate the savings portion the same week your new income takes effect, before you adjust to the higher spending capacity. The tax optimization layer is another area where automation adds significant value. If you're in a taxable brokerage account, many platforms now offer automated tax loss harvesting. The system continuously looks for opportunities to sell positions at a loss and replace them with correlated assets, locking in tax savings without changing your overall market exposure. Wealthfront, Betterment, and several other platforms offer this as part of their automated investing service. Over long horizons, automated tax loss harvesting can add meaningful after-tax alpha. Cash management automation is often overlooked. Your emergency fund and short-term savings should not be sitting in a standard checking account earning near zero. Keep your savings in a high-yield savings account or a money market fund. In 2026, rates on these accounts remain meaningfully above traditional savings rates. The automation piece. Set a target balance for your emergency fund, typically 3 to 6 months of expenses, and automate a monthly contribution until you hit that target. Then redirect that contribution to investing. When the account dips below your target, the contribution restarts automatically. Finally, monitoring automation. The whole point of this system is to remove active management from your week, but you still need visibility. Set up automatic monthly or quarterly reports from your brokerage and bank accounts. Use a net worth tracking tool, personal capital, Monarch Money, or even a simple spreadsheet that you update once a month with 5 minutes of effort. Set alerts for unusual transactions above a threshold you define. This way, you get the benefit of eyes-off day-to-day operation with just enough check-in frequency to catch problems early. Building this system takes about 2 to 3 hours the first time. After that, your maintenance overhead drops to under 30 minutes a month. That's the trade. A few hours of setup work in exchange for years of effortless financial progress. The people who build systems like this don't have more discipline than everyone else. They've just removed the need for discipline from their financial lives. If you want the exact checklist I'd use to set this up, subscribe and check the description for resources. And tell us in the comments, what's the one financial task you most want to automate that you haven't yet?